Mastering accruing methods, accrual versus cash explained. Have you ever wondered why two businesses can make the same sale but record the money at completely different times? That difference comes down to the accounting methods they use. The two main accounting methods are cash accounting and accrual accounting. The understanding between them is essential. Let's start with cash accounting. Cash accounting records money only when cash actually moves. That means income is recorded when the payment is received, and expenses are recorded when money is paid out. Simple enough. Money in, recorded, money out, recorded. Now let's look at accrual accounting. Accrual accounting records income when it is earned, and expenses when they are incurred, even if the money hasn't moved yet. Okay, let's see. This means the timing is based on the business activity happens, not when payment arrives. Let's make this very simple for you. Imagine you do a job in June, but the customer pays you in July. Under cash accounting, that income gets recorded in July because that's when cash came in. Under accrual accounting, it gets recorded in June because that's when you actually earned it. Same sale, different recording date. The same applies to expenses. If you receive an electricity bill in December but paid in January, cash accounting records it in January, while accrual accounting records it in December when the expenses was created. So why do businesses choose one over the other? Cash accounting is easier and gives a clear picture of actual cash in hand. That makes it popular with smaller businesses. Accrual accounting gives a more accurate picture of true business performance because it matches income and expenses to the period they belong to. That's why larger businesses usually use it. Now here's the major difference. Cash accounting tells you your cash position. Accrual accounting tells you your business performance. A company can look cash rich but still owe lots of unpaid expenses, or how it can look on cash but actually have strong earned revenue coming in. I mean, or look low on cash but have strong earned revenue coming in. That's why the method matters so much. A common misunderstanding is thinking one method is universally better. It is not. They serve different purposes. Another misconception is that the accurate accounting means fake money. It doesn't. It simply records obligations and earned income before payment is exchanged. What's the key takeaway, you ask? Even if you don't know, I will still tell you. Cash accounting records transactions when money physically moves. Accrual accounting records them when they are earned or incurred. One focuses on cash flow, the other focuses on financial reality. Once you understand the difference, you see why accounting is not just about money, it's about timing. What do you think of this? How about a comment if you liked it?